Welcome, everybody. Have you ever heard somebody say this stock is undervalued because its PE is only 12? Or this stock is trading below its book value and it's a bargain. Let's go buy it. You see, these ideas came straight from the early days of value investing when Benjamin Graham laid down the rules like PE and PB ratio. Now, for decades, they were the gold standard. And you must have seen these books too, right? The Intelligent Investor, the Stock Analysis, these were gold standards and still are. But here's a problem. Today's companies don't look like the companies Graham was analyzing back in his days. We've moved from steel mills and telephone wires to companies that now have code, platforms, algorithms, data. And in this world, the old tools don't always give us a full picture. So in today's session, I'm going to show you why PE and PB that used to work so well before don't necessarily do so anymore. They can often mislead investors today. I'm going to show you how modern businesses create value in ways that those metrics cannot capture, and what I use instead, including how I still use PE wisely without falling into the trap of treating that ratio as a gospel. By the end of today's webinar, you're going to understand not only just what has changed, but also how to evaluate businesses through a more modern lens, the one that I have been refining over the years, which I call the modern value investor approach. So let's dive in. So Benjamin Graham, this guy is widely known as the father of value investing, laid down an intellectual foundation of how we evaluate stocks even today. His two landmark books, The Intelligent Investor and The Security Analysis, weren't just theory. They provided framework that investors used for generations. Even today, people study this in their masters. At the heart of this method were tools like the price to earnings ratio and price to book ratio, which is PE and PB. Now, these make perfect sense in that world, a world where most of the companies were valued based on what they owned and how steadily they earned. So when a stock traded at a multiple or much below its book value, or a low multiple, for instance, it often signaled a real bargain. So something tangible that could be liquidated or even turned around. So these companies had tangible things that you could touch. Warren Buffett even started in the same tradition. But as the economy changed, so did his approach, shifting from balance sheet bargains to long-term compounders. The key takeaway here is that Graham gave us a timeless principle, and his principles also consisted of discipline, margin of safety, value over hype. But specific tools that he used were designed for a very different kind of business than several of the ones that we are able to evaluate today. During Graham's time, from 1930s through 1960s and even beyond, the largest and most widely followed companies were industrial giants and capital-intensive businesses. So if you think of that time, you will think of companies like GE, US Steel, IBM, AT&T that had tangible assets that you could touch and feel. So for example, General Motors, it built cars, it owned factories, it had warehouses, it had massive inventory of things. US Steel had steel mills, raw material stockpiles, trains, ships. GE, from engines to turbines, its balance sheet was filled with tangible infrastructure. IBM in its early days had massive investments in mainframes, leased hardware, manufacturing lines. And AT&T used to build physical telephone lines with towers, switching centers, and even real estate. For these businesses, book value mattered. Remember, book value is assets minus liabilities. So book value mattered because it represented real monetized assets. So when the market price fell below the book value, the investors could reasonably assume that the stock was coming close to or was better than its intrinsic worth, even at liquidation scenarios. And the earnings were fairly steady and straightforward, which made price to earning, the PE ratio, reliable guide to the relative valuation. Now, that's why tools like PE and PB worked so well back then. They reflected economic reality because the economy was built on tangible things. But so before I go further, I'm going to give you a quick refresher on what PE and PB are and how you calculate them. And for those of you who have attended my sessions on the 5-minute test, you'll notice that I go through the PE at that time. So PE, which stands for price to earnings, is basically stock price divided by earning per share. So P over EPS, and EPS is net income divided by number of outstanding shares, right? Now, why I'm writing this formula down is because if you increase or decrease any portion of the denominator, you'll notice the price to earning actually starts to shift very rapidly. Now, for those of you who are in our Telegram, I started to give tits and bits of this a few days ago to start to get guys to start thinking in this direction. So this is the reason why I was getting into it. Now I'm going to talk about later on how these affect, but let's just have a look. Let's say if in a company, the number of outstanding shares increase. So if this goes up, remember if a denominator goes up, then this denominator, which is the EPS is going to go down, which is net income over number of shares outstanding. And if the denominator goes up, guess what? The whole ratio is going to increase. Similarly, if the net income increases or it goes down, it'll have different kinds of effects on the PE ratio. And the same thing happens in PB. And all this can affect the PE and PB ratio while the price of the share remains constant. Now, isn't that interesting? If the share stays constant, just by the movement of PE and PB, one can start to feel or interpret the stock as being expensive or cheap. Is that sensible? We're going to explore that in a bit. Now, as I move forward, let me also show you what PB stands for. So PB stands for price to book, so which is price divided by book value per share. And what is book value per share? Book value per share is just assets minus liabilities over total number of outstanding shares. So number of shares outstanding. And if you notice assets minus liabilities, this is same as shareholders' equity. Shareholders' equity. So again, in this case as well, if the numerator of the denominator goes up or down, that's going to start having an impact on the whole PB without the price actually moving at all. That's where the mathematic comes in. So when you just simply say, okay, price to earnings is going up or the price to book is going up or down, that's not necessarily reflective of how the company may be behaving. So we're going to dig deeper into it. So I wanted to give you a quick understanding of what the formulas are because we're going to use these in a bit. So today, the leading businesses like Google, Meta, they don't own factories, right? Their value lies in what? Data, platform, intellectual property, which are intangibles. They're not tangibles. You cannot touch and feel them. So because they're not tangibles, these are the companies that are actually value creators. So what are the value creators in these companies? These are platforms, data, intellectual property. But if you go back in Graham's time, the value creators were not intangibles. They were physical goods like machinery, real estate, factories, etc., etc. The intangibles do not appear in the book value. So guess what? The price to book ratio that I just talked about often becomes meaningless because the assets, so let's say a company like Meta may have hundreds of billions of dollars in algorithms in their software, but it doesn't get represented in the asset portion. So if it doesn't get represented in the asset portion, guess what? The book value per share goes down, and then what shoots up is a price to book value, while the share price may remain constant. So what I want to do now is I want to go through a few items that can distort PE and PB. So, and I'm going to walk through a few of them one by one. So first is stock-based compensation. So when a company issues stocks as a part of an employee compensation, that's called stock-based compensation, and we can abbreviate it as SBC. So now, even though no cash leaves a business, remember, if you work in a company and get stock-based compensation, the company is not giving you cash. So in other words, no cash leaves the business. But according to the GAAP, which is generally accepted accounting principle, GAAP requires the share-based compensation to be recorded as an expense. Remember, it's being recorded as an expense even though no money has left the company. So what does that do? It keeps the money intact in the company, but it reduces the net income. So let me show you. So going back, remember price to earning is equal to price, which is share price, divided by net income, divided by number of shares outstanding. So net income is revenue minus expense. So when share-based compensation occurs, even though cash is not left, this gets recorded as an expense. and they call it share-based compensation. So as the expense increases, the net income goes down. And as the net income goes down, this whole thing, the denominator goes down, and guess what? The PE shoots up. That's a problem. So this makes a company look expensive even though the share price has remained consistent or unchanged. And this has nothing to do with the business performance or the performance of a business. In fact, the company may still be generating strong cash. But according to Graham's framework, this thing would be flagged as a stock that is overvalued. But in today's reality, this is a distortion caused by accounting, not economics. So that's a first reason why PE may look expensive. The second reason why PE may look expensive is because of our research and development, or R&D. So research and development, as you know, is one of the most important investment a company makes. It's how a company builds for its own future. But here's a catch. Under GAAP, which is generally accepted accounting principles, R&D is treated as an expense, just like rent, salaries, and utilities. That means that when the company ramps up R&D to innovate and expand, it shows up as a cost in the net income, not as an investment in the long-term growth. And as expenses go up, net income falls, and that lowers the EPS. And because the stock price hasn't changed, the PE starts to rise. So I'll show you again. Price to earning is equal to price divided by net income divided by shares outstanding. So net income is revenue minus expense. So R&D gets recorded as an expense. So expense increases, which reduces the net income, which reduces its overall denominator, and the price shoots up. For those of you who are watching, I just hope you guys understand how fractions work. So when the denominator goes down in a fraction, the overall equation increases. And if the denominator increases, the overall equation decreases. So that's why the PE would look expensive. But remember, this doesn't necessarily mean that the company has deteriorated in its business quality. It may still be producing free cash flow. It may still be increasing its revenue, but because the expenses have gone up, that too just recorded as expenses in the net income, the PE shoots up and the stock starts to look expensive. Some companies, folks, trade at a consistently high PE. Now, that's not a mistake or a bubble. It's because the earnings are predictable and people are willing to pay more for that stock. So think about businesses like Visa, Adobe, Costco, Apple. Now, these companies generate recurring, stable, and steadily growing earnings. When a business performs that way quarter after quarter, year after year, what investors start to do is they say, great, I'm willing to pay a premium for that company because I know it continues to grow. They pay for certainty, they do not pay for hype. That's why a high PE ratio doesn't always mean the stock is overpriced. I've already shown you mathematically, but I'm now showing you that there are certain companies that do really, really well and they consistently grow. Their PE is also high. So that high PE actually ends up reflecting the market confidence. That's why the company will keep compounding its value reliably, which is the hope of those investors. Now, that's exactly why in my 5-minute test, I don't look at PE in isolation. I look at it in context, comparing with historical trends and how the company has behaved compared to its industry peers. Because only then can we ask the right question. Is this because the stock is expensive or because the business is excellent? So I have an example of Adobe here. So you'll notice I took a screenshot of this a couple of days ago. So the PE at that time was 24.96. Now, if you were to look at purely Graham's methods, this is a very expensive company. But if you look at its history, remember I said you can't look at a PE in isolation, similar to how I show in my 5-minute test. So PE is 24, but the average is 49.15. But sometimes you have to also, when you're looking at this, if you go to fullratio.com, expand it over the years. There are certain companies where the PE average may look very expanded, but there may be certain anomalies. So Tesla, for example, is a great example of that. So, a holistic view has to be seen. And you can also use an analysis to see how the peers were doing and compare it accordingly. So not look at PE as in isolation, but collectively. Now, one of the biggest problems with price to book ratio is that it relies on accounting book value. So now I'm looking at PB, not PE. So book value often ignores what actually makes a modern company valuable. So here's an issue. Under GAAP, which is the generally accepted accounting principles, if a company builds something valuable like software, data, platforms, or even brand equity, that is not allowed to be listed in an asset. So let me write this down. I'm going to show you what may be unfair as well. So if we look at software, brand, data, networks, according to GAAP, this is not allowed to go in the asset. So not allowed. But if the same company goes and buys another company that has all these software, brand, data, network, then that value is allowed to be entered into the asset column under the generally accepted accounting principles. But companies like, Meta, Google, Apple, etc., these companies may have hundreds of billions of dollars in intangible assets that are not recorded in their asset section, unless they bought it. But they have also already they have developed a lot of this themselves. So when they have developed all this and it's not part of the asset, then what happens? The assets are not very high or they're not realistic. So assets minus liabilities, which represents shareholders' equity, is also not reliable. So when you look at price to book ratio, which is stock price divided by book value per share, which is price divided by assets minus liabilities divided by number of outstanding shares, guess what? The assets are too low. Assets are not reflective of what the company is really doing. And when the assets are too low, this whole denominator goes down. And when the denominator goes down, look what happens. The price to book value actually shoots up. So in a case like this, if the stock remains unchanged, just because the PB has gone up based on our conventional principles that have been taught over the years, one would start to say the stock is overpriced. But is it really? Not necessarily. This is where you need to go deeper. Now what I'm going to do, I'm going to walk through case studies, but before I transition there, I want you to remember that price to book and price to earnings should not be seen in isolation, and they should not be the only numbers or ratios that you use to value a company or value a company's worth. They should essentially tell you what you need to look deeper into. So now let's go into a case study, and this case study is Amazon. So Amazon, an exciting business. It's increased the value of its shares consistently for a long time. A lot of people have made a lot of money in this company as well. But if you looked at Amazon using traditional tools, which is price to earning and price to book ratios, you might have thought that this company was outrageously overpriced for many years. So for example, look, from 2013 to 2016, so right here, 2013 to 2016, check out the price to earning ratio. So PE ratio, look at this. 664 is the PE. Then 0 PE after that. Then the PE jumped up to 536, then 153 and 189. This, based on conventional principles, would be a mad company, like ridiculously expensive. But and also, you notice that like some of the years it didn't even exist. Now, why do you think the PE would have jumped up a lot? So let me write the formula again. PE is equal to price divided by net income divided by number of outstanding shares. So why would the PE shoot up? The PE would shoot up because the denominator has gone down. How would the denominator go down? Either the number of outstanding shares significantly increase or the net income goes down. In their case, the net income was extremely low. Why? Because they kept investing their money over and over again. We're also going to find out why that is the case, but essentially the net income was very low. That's why in certain years, when the price to earning was showing up as nothing, like this is 0, because there was no net income. So the formula turns out gives you an unsensible number. But what we need to look at is the free cash flow. And what is free cash flow? Free cash flow is actual money available to reinvest or return to shareholders. This figure was growing year after year. So check this out. And by the way, this is in millions of dollars. So a four-figure digit represents billions. So even in 2010, the free cash flow was 2.5 billion, then 2 billion, 395 million, 2 billion, 1.9 billion, 6 billion, 9 billion, 6 billion, 17 billion, so on and so forth. So that represented that the company was actually doing really well. Now I'm going to bring your attention to one more thing. Amazon was reinvesting in its infrastructure a lot. So if you look from 2013 to 2020, for example, this company was investing a lot of money through capital expenditure. So it was buying and investing in itself, plus also investing in a few things such as Amazon Web Services. This is their software or data hosting, elastic computing, and all that. That's what they were investing their money in. They were also investing in logistics and customer data and their brand. So this is where they're putting their money in. Consequently, the share price continued to grow at that time and the company continued to do well. Now, I want to bring your attention to the price to book value. Why? Because the things that made it valuable, such as the Amazon Web Services software, logistics system, customer data, brand, did not show up in the balance sheet. So look at the PB ratio. It is 11, 10, 13, 18, blah, 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 so on and so forth. Let me write down the PB. So price to book ratio is stock price divided by assets minus liabilities divided by the number of outstanding shares. The price to book ratio was actually higher. According to Ben Graham, the numbers are around 1, which show whether the price to book ratio is heavy or not. This is like 11 and whatnot. So the price to book ratio was showing very heavily. The reason was because the assets that the company was putting its money in were not being reflective. So here's a key takeaway. Amazon was never cheap according to Graham's definitions, but it created enormous shareholder value. And that's exactly why traditional metrics like PE, PB often fail in modern market. And that's why I believe that we need a more complete lens when we're looking at companies, one that understands the businesses, not just the ratios. Now, second case study I want to walk you through is IBM. So this is another case study that shows why we cannot rely on price to earning ratios in isolation. So IBM, as you know, is a well-known, long-standing company that many investors have followed over the years. And for much of the last decade, it traded at low PEs, at times below the market average. So check this out. So here's a PE ratio. Look, low PE ratio ever since 2010, 12, 13, 11, 10, 9, 8, 11, 10, etc., etc. Now, on the surface, this is going to look really good, right? So to an investor who doesn't understand deeply, they're like, oh, great, this company is underpriced. Let me go and buy it. But what I want you guys to do is when you see something like this is to look deeper into the fundamentals so the story becomes more complete. Remember the 5-minute test and the 10-year filter that I have? They force you to go into the depths of the company. So what do you need to look at in a case like this? Well, between 2011 and 2020, the revenue declined steadily in this company. So 2011 to 2020. Here's a revenue. Look at this, 106 billion. And by the time 2020 came out, look, 55 billion. At the same time, the earning per share fell even though the company was buying back shares aggressively. So here are the EPS. It continued to fall. So 13, and all the way when time came for 2020, it was sitting at 6. And what was happening to the number of shares outstanding? Check this out. They were being purchased, so the shares were going down. Generally, that's a good thing. But in this case, not necessarily. So look at this. So the 1.2 billion shares, by the time 2020 came out, it was 896 million shares. And here's the key. The free cash flow per share did not grow. Here's a free cash flow per share. It didn't grow. So it was sitting at 12, 12, 12, 12, 13, 13, 12, 13, 16, then went back to 11, 9, and so on and so forth. I want to impress upon you that IBM is not necessarily a bad investment, but it does mean that low PE ratio did not reflect the business strength. And that's a point that I'm trying to make. A low PE doesn't always mean that the stock is undervalued. Sometimes it reflects that investors have some kind of concerns about the trajectory of the business. So this case study shows you why it's important to go beyond simple matrix and analyze the full picture instead, including revenue trends, capital allocation, and cash flow quality. So far, everything that we have seen from Amazon's misunderstood PE and IBM's low PE multiples essentially hide deteriorating business in IBM's case. So you might be wondering, does PE still matter at all? And my answer is absolutely yes, but it's only a starting point. I still use PE in my 5-minute test, but I use it as a filter. It's not my final judgment call. So if I see PE of 80, I don't automatically say, oh, this company is really expensive. I ask, why is it 80? I wanted to bring this to your attention today because when you turn on TV and you watch, these analysts, they'll throw things like that. Oh, the PE is this, the price to book ratio is this. So you guys, as intelligent viewers, should be like, all right, if the PE is high, why is the PE high? Is the company reinvesting heavily? Is the gap income distorted by stock-based compensation or research and development? And same thing with PB, right? Price to book ratio. For some sectors like banks and insurances, by the way, I do want to impress upon you, PB is still relevant. Why? Because the value of the company is actually in its assets. But for most modern businesses, it just doesn't tell us much. Instead, I go deeper. I want to know, is the company generating real sustainable free cash flow? Is it reinvesting wisely? Or is it wasting capital? What kind of return on invested capital is it earning, which is ROIC? Because in today's world, how a company grows and allocates capital is far more important than what its PE says on a stock screen. So let's bring this whole thing home. We're not here to throw out value investing. We're not abandoning Graham or Buffett. In fact, their principles, which consist of discipline, patience, and focus on fundamentals, are more important than ever. What we are actually doing is recognizing that the world has now changed. The tools that worked in an asset heavy, manufacturing driven economy don't work the same way in a world that is now dominated in software, platforms, intangible assets, algorithms, etc. So, what we need to do is we're not looking for a replacement, but we're looking for an evolution. That's what I call modern value investing is all about. It keeps the discipline, but updates the lens. It asks not just what a company earns, but it asks how it earns it, how it reinvests it, and grows in today's economy. Folks, I hope this was valuable for you and it gave you some insights on valuation.